Hello, my name is Mike Sinibaldi and welcome to this week's video edition of Heard on the Street. In this edition, I'm going to take a look at the following markets: the S&P, the US dollar, and crude oil. The first market I'm going to talk about is the S&P. In last week's edition of Heard on the Street, I left readers with this weekly chart. The market traded to 1252.25 and found support at the 200-day moving average. Support remains just below the market at 1241 to 1246. Interestingly, what buying interest manifested itself among institutional players at the 200-day moving average quickly negated itself, and the market barely finished in positive territory for the week. The spinning top or doji candle illustrates indecision between market participants. The near-term price action at the daily chart level of the September contract is problematic to my analogy, as the daily session appears to have made a Wave 3 low. The only reason for the difference in the Wave 3 termination points is that Wave 1 on the September contract is 11.75 points lower than the Wave 1 termination point at the daily session chart level. At the present time, the daily session counts better, and Wave 3 equals a 1.618 multiple of Wave 1 at 1351. The subdivisions of Wave 3 can be labeled in two ways, where minute Wave 3 ended here or here, yet either way arrives at the same conclusion, to be looking for a counter-trend rally. Note the slight divergence between the MACD and price as Wave 3 completes. Moving forward, until the near-term wave structure on the September contract is brought into focus, I will be using the daily session for near-term forecasting. With Wave 3 complete, Friday's rally started with a bang, then fizzled in what I believe was the first part of a larger ABC fourth wave rally that should terminate where Wave 4 equals 0.382 of Wave 3 at 1288. Also note that the lower boundary of the price channel also comes in at 1288, making the level an attractive location to add to a short position or trade the final leg of the 5-wave decline. Also note that the red dashed line denotes 1308.75, where the interpretation for a fourth wave price action will be invalidated, as Wave 4 cannot enter into the territory of Wave 1. Structurally, 1308.75 is a key area, as the market has found either support or resistance around this number since 2011, as in here, 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 and most recently, the break of this level indicated that was once support will now be resistance. For Monday, look for another leg to the upside that should carry prices between 1286 to 1288. Evidence supporting such a claim can be found on the 3600 tick chart. The move from 1252 1/4 to 1277 1/4 was Wave A, B, C. That was followed by a 7-wave affair, a double zigzag for Wave B. Currently, Wave C of 4 is unfolding, where Wave 1 and 2 are complete. Price has no business below 1261.50 if this interpretation is correct, due to the fact that Wave 2 cannot exceed the origin of Wave 1. Additional confirmation that the counter-trend rally is still unfolding will come from a break above the corrective price channel on a closing basis, and ultimately the Wave B extreme at 1270. The next market that I'll cover is the US dollar. At the monthly chart level, the US dollar appears to have bottomed. While I remain cautious this market, the wave labeling implies that the dollar is in rally mode regardless of the count. The decline from 89.71 to 72.86 was a flat correction for either interpretation. But how will we know if the market is just making another corrective move or part of a larger impulsive move? Here's how. If the next move up is corrective, expect upside potential to where Wave C equals Wave A at 91.52, or where Wave C equals a 1.236 to 1.382 reverse Fibonacci extension of Wave B circle to 93.68 to 96.14. Should 96.14 be exceeded, then odds are that prices will eventually carry to 103.05. At the weekly chart level, I had indicated that I would need to see a close above 76.05 to confirm a tradable low. Well, we still do not have confirmation, and prices failed to take out the upper boundary of the larger corrective price channel. Furthermore, as long as price remains in the smaller channel, we cannot get overly bullish. In addition to closing above 76.05, a print above the red dotted line of 77 creates wave overlap that would bolster the case that a tradable low was in place. Here at the daily chart level, notice that the minimal expectation is for a wave C equals wave A, three-wave move to 77.19 if the move off the low will just be corrective. As with the S&P, the 77 area is a key level that the market has found to be an important level on numerous occasions, so watch how price reacts to this key level. The final market that I'll cover in this week's edition of Heard on the Street is crude oil. At the weekly chart level, prices traded to within the span of the previous fourth wave, and the market looks like it will make an attempt to close the gap. On June 1st, I mentioned that things were going to get ugly for oil. Oil is roughly down 7 points from that call, but the wave pattern that unfolded wasn't exactly what I've called for. What you see here on the weekly chart is my revised forecast. If you recall, at the daily chart level, I was looking for wave 2 to complete between 105 and 108.5, then fall in wave 3. That's not what happened, as price traded down since the original call and now appear to be working an expanded flat for wave 2. A, then wave A, B, C for wave B, followed by wave C. If this is correct, prices need to rally quickly, as further declines would suggest that the expanded flat interpretation would be questionable. There is, however, a significant level of support as well as the gap just below the market between 89.75 to 90.50 that should cap the recent declines. Don't be surprised if we see these areas tested before seeing a bounce this week. I hope you found this video helpful, and best of trading.